All right, hey guys, Sam here. Since this is the first video for this group, what I want to do today is to combine both analysis of the markets, and we'll look at the two majors. We'll look at Bitcoin and Ethereum. But what I really want to show you and demonstrate to you is the methodology by which I approach any market. It doesn't matter if it's crypto or forex or equities or futures. Doesn't matter. It's the approach, and I propose to you that if you follow this approach and apply it to your own analysis, that you'll find that one, it's amazingly accurate, and two, if you're not profitable with your trading right now, I want to suggest to you that if you apply this consistently with the discipline of strong money management that's required to be successful in trading, that this will really serve you well, and it'll give you a confidence when you approach any market that you may be interested in terms of the consistency of the methodology and how it applies to where you enter, where you exit, your targets, exits, etc. So we're going to keep this relatively simple because it doesn't need to be complex. And a lot of times I think the traders make the mistake that they think that there's some magic methodology and that there's some technique or an oscillator or some magic bullet that's going to make the difference for their trading success. And it's really quite the opposite. It's the simplicity and the consistency combined with the money management that really determines whether or not you're profitable or not over the long term. Hey, nothing is perfect. There is no magic bullet in the markets. The markets are imperfect. There is a lot of chaos, and they are quite unpredictable. What we can do is work with probabilities. That's all we can ever do, is work with probabilities and be consistent in how we approach the market. And it's that consistency on the assumption that it's based on patterns that repeat regularly in the market. It's that consistency that allows you to be profitable, knowing that you're going to be wrong more than you're right. That's the first assumption you should always make. That's a reality of trading. You cannot let your ego dictate how you approach the market. We're always looking for simply a risk-reward scenario that's favorable to us. And if you follow that mindset and the methodology that I'm going to show to you, I think you'll find that you'll have a very successful experience in the markets. So because you all are coming from different levels of technical experience and trading experience, I'm going to try and keep this relatively straightforward. There may be some repetition for some of you guys. Perhaps others, you're really going to get your eyes opened. But I think what you'll find is that it's relatively simple and that it's something that anyone can apply. So I want to start with Bitcoin, of course. Right? We're all trading it. We're all amazed by it. And we're all, I think, inspired by the technology behind it. So because this is something that we're all looking at, let's just approach it. And I like to always encourage people to approach the market just on price. And now, Grant, I have a couple of moving averages here, but I don't want to pollute the chart initially with oscillators or pivots or anything that might confuse what I'm looking at. So the reality of trading is that price is truth, right? As a technician, we make some assumptions. And one of the assumptions is that everything that can be known is at any moment in time is reflected in the price of the market. So our approach is really not about why it's moving. That really might be a subject for another video. Why it's moving is almost secondary to us. What matters is how it's moving, and can we position ourselves within the market where there's opportunities where we can get into the movement of the market and position for a risk-reward scenario that's favorable to us. And despite the fact that we know we're going to be wrong more than we're right, again, with that good money management and a risk-reward that is in excess of 2 to 1, 3 to 1, 4 to 1 and above, that we can be wrong multiple times and still be profitable, because when we're right and we know how to move with the market and add when the opportunity is there to add. Those times that we're right will well compensate us for all those times that we're wrong and that we get stopped out and we're frustrated and think that the market is just random and chaotic. It's not, particularly these days, because the markets are driven almost entirely by algorithmic trading. And again, if you believe me, they are in crypto. But again, this approach, it doesn't matter what market you're looking at. It doesn't matter what time frame you're looking at. From a monthly to a 1 minute to a tick chart, it's the same thing over and over again. And that's why my premise to you in this group is that after seeing this and applying it and getting some screen time and some trading experience and dealing with the emotion of money, that's always a complicating factor in trading, that you'll be able to take this knowledge and apply it to whatever market interests you, and that consistency will serve you well. So let's take a look. Now, one of the things that we got to deal with is that because you all are we all could well be trading on different exchanges, I'm going to mix it up a little bit. Now, I trade on 3 exchanges. I trade on Kraken, I trade on Poloniex, and I trade on Bittrex. U.S. exchanges, I prefer that. From Austin, Texas, I'd prefer to trade here. I have traded with some other exchanges, one in Hong Kong that we can get into as we progress here. But for right now, I'm going to stay with the 3 major U.S. exchanges. And there will be some variation if I'm showing you something on Kraken and you're on Poloniex. There will be some slight variation, of course, from exchange to exchange, but the methodology will be consistent, and those little differences in price from exchange to exchange won't matter. So anyway, here we have a daily chart of Bitcoin. I've got a 20-day, a 50-day, and a 200-day average, and I keep those on my charts at all times. I'm not really a moving average trader, but I like to be cognizant of where they are and how the market is responding to them. So if we look at this, of course, we behold the raging bull. I mean, there's just, it's a spectacular thing as a trader to look at. And that's what's drawing so much attention to Bitcoin amongst the trading community. And because there's a lot of people coming into the market, and there's a lot of algorithmic trading as well. There's a lot of opportunity. I like to stick with the markets where the most volume is being traded, because that creates the crowd dynamics and the crowd behavior that's reflected in the markets, and you see that time and time again. Fear and greed being repeated by the reflection of what's happening in the price chart. So let's just approach this market. So I like to start on the daily. I encourage you to do that as well. Now, one of the things in crypto is that because so many of these assets are newer coins, you don't have a lot of data to work with. But with Bitcoin, we've got some history to work with here. So a daily chart works for us. We can look at this, and there's some really obvious things that we can see right off the bat. So I would propose to you that while, of course, Bitcoin goes back, to 09, 10, there's data here. It really is not meaningful for us in terms of our current analysis until we get here until March of this year, where we put in this low at 800. Okay, and take note, that's March of this year at 800, as we sit now, above 4,000. This is our meaningful low. So if I were approaching this market, again, it wouldn't matter whether it was Bitcoin or not. If this was just any chart, I would start from this low, and note that we tapped the 200-day there as well. Now, the most important tool that you're going to use, and I propose to you as you approach any market, and the most important tool for me, and perhaps is one of the most misused and poorly applied and most regularly used tools, is the simple retracement tool. Now, I want to encourage you to make your settings exactly as I've got them. So I've got my fib retracement tool here, and I want to just show it to you over here so you can look at it, and then I want you to duplicate this as well, because I think you'll be amazed at what you see if you haven't seen this before. So here's the tool as I draw it out. Now, sorry guys, I want to keep those background. As I draw it here, it's not relative to price at this moment. I just want you to see the settings. So I want to highlight it. And I want you to do the same thing here. So I like, for me, it just helps me so I don't have to look at anything other than the color. I like to keep the 50 and the 100 at red, the 618 at gold, of course, golden ratio, 786 at blue. I keep the 382 on the chart. I want it in a lighter color because it's a secondary fib ratio for me, and I think you'll find that while it's important to be cognizant of where it is, and it will have value in stronger trending markets. It's a secondary indicator in the same way that the 786 is secondary. The meat of the trading principle happens between the 50 and the 618. Our targets will also be fib numbers, but they are the negative 236 and the negative 618. So you might just take note of how this is set. We've also got the negative 100%. And again, I keep that in red. To be consistent here, I should put that in gold as well. Okay, so let's, with that set, I'm going to take it off the market now and just apply it here. So we're going to go back to this low, and we're going to draw some swing highs. So as the market is moving higher, this is happening as we go. But we have the benefit of hindsight right here. But if we had been in this, been in the markets during this period of time, and we go through this rally, well, of course, we've got these swing high here's that you can see. So we come back down, we retrace. We don't quite make the 50. And this is in very strong markets. You'll see it's a front run of the 50 at the 38.2. We don't make the 50. We get through the 382. We go up. We don't make our first target. We know our first target is negative 23.6. We don't make it here. We come back. We retrace again. We don't quite get to the 50. Again, we've got a strong market. We've got this little cluster here where there was previous indecision, and then the market rocks straight up, and we get just a few dollars shy of the negative 23.6. That's our target. So we know that there are algorithms that are programmed to take profit at that level. So even though we don't tick it, we get close enough to it. I promise you that's algorithms taking profit there, and the market starts to fall back down. We fall back down to the 50. We are now starting to make lower highs. The market comes all the way back down. We get through the 382. Again, we're a little bit shy of the 50, but we start moving up. Back up right to the 23. We stall again. So players that were long from this, off of this pattern here, have another opportunity to take profit. But take note that as we've now hit this once, we want to come up to that new high. Now, as we look at it, we come down, we tap the 50, we go through it by a few dollars, and then we scream higher. We stall at that previous high, commonly seen. We retrace, then we go off. We stall again at the 23.6 here, off to the 618. We get through it, and look where we end up topping. But, so that, of course, that's the benefit of hindsight. If we were trading this along the way, the point I want to make to you here is that as that market gets through that 23.6, we're now redrawing, and we don't get to a new high until we get here. Now we're working now from this last pivot low. Right? So we come up, we come back down, nothing. But take note here, within this, we have this happen here. All right, again, this pattern seems to be repeating. The market is so strong, it's not getting to the 50. We take off. We stall. We get through the 23 to the 618. Now, at this point, we know that we've got a swing low here, and we've got a pivot here that's meaningful. Let me open this up a little bit for you to see it. So if I'm going to take that off. So if I were applying this, I'd be to my swing low here and be applying up. I don't get anything meaningful here for a pullback because we go straight up. And again, we're so strong, we stall at the 382. We don't quite make the 50, and we go up. Now look where we go. Right to the 23.6, almost to the dollar. Again, algorithms taking profit there. This pattern alone, if you got nothing else out of this experience here with this trading group, you'll find your money and time is well invested. This pattern alone is all you need to trade consistently and profitably in the market. It's amazingly consistent because this is how the algorithms are programmed, and you'll see this time and time again. Now, it's happening on every time frame. So we're looking at it here on a daily. We're going to break it down into smaller time frames where it's more tradable because of the distance between where we'd have a stop and where we'd enter the market is so much greater on a daily chart. Now, of course, we've got traders with different account sizes and different risk tolerances. My point here is just to demonstrate this pattern reflected, and we could be looking at the Dow, we could be looking at the NASDAQ, we could be looking at Facebook, we could be looking at IBM, we could be looking at the Euro. This pattern repeats over and over again. It's called a measured move, and it was actually really first popularized by a guy named David Halsey. It was just through a lot of study and a lot of screen time and a lot of experimentation that, of course, the fib retracement was that's been around for a long time. It was the target. It was acknowledging where the algorithms were taking profit. That was his contribution to this. So I encourage you to really pay close attention to this and start to look at it as you analyze the market. Now let's take this off here. And I guess the point I want to demonstrate is how this is happening on so many different levels. Let's go down. Let's go down to an 8-hour. Now, of course, any of you with any background in Elliott wave, just the most basic premise of the markets moving in 5s and 3s, impulse in 5s and correcting in 3s. Well, of course, you can see we've got a 1, 2, we've got a 3, and we've got a 4, and we've got a 5. Now, there's some question as to whether or not we've got a good top here. But that's really secondary. I've spent a lot of time studying Elliott wave. I'm a certified Elliott wave technician from Elliott Wave International. I know Elliott wave. What I'm going to tell you is that you don't need it. It has value. I use it. I can't help but see it when I look at the market, but you don't need it. And there's a lot of nuance and subjectivity to some of the count structure. My belief is that if Elliott wave is not so wildly apparent and obvious in the market, that you're really better to just focus on the swings, the retracements, and the targets. You don't need the Elliott wave, but I am going to refer to it. I do use it, so there will be reference to it. But I don't want you to feel like you need to become an expert in Elliott wave theory to trade successfully in any market. You don't need it. The wave structure is built and forms off of the retracement and the target relationship. So with all that said, let's just start to break this down. So now on an 8-hour, right? Again, we're still, on a time frame here where if you're letting the market dictate your stops, there's a fairly good amount of risk in any given trade. But let's look at this and see if we can make some sense of where we are now in the market. So the last swing low we had here, so again, to use both a swing low as well as an Elliott count, that would be a wave 2. We can go up to what would likely be the wave 3, and you can see this happening here as we just demonstrated. So again, in Elliott theory, not to belabor it here, but in Elliott theory, the stronger the wave count, the stronger the impulse, the more likely the market is to pivot at the 382 and not make it to the 50. And you see this happening again with Bitcoin here, and again there we see our target. And that's, I mean, it's almost to the tick, right? It's just remarkable how consistently that happens. So if you were approaching this market again without the benefit of this hindsight, and we were just looking at these pivots, of course, we need a couple of pivots and a couple of swings to work from. We'd work from this pivot low now, and we'd go to this pivot high. So what do we see now? Well, of course, the market has come down and double bottomed right on the 618. And I promise you that is not coincidence. There are a group of traders and algorithms that are written to continue to buy the market above the 618, and we see it repeating here. All right, so this double bottom that's a bullish sign. But at this point, we don't know how the market is going to resolve. We know that we are in a very strong impulsive structure. We're in a trending market, but we don't know where this resolves because of this pattern here of higher lows now double bottoming. So we don't actually we have higher lows from this pivot, but we've got this double bottom structure here, which is suspect, because for the pattern to be perfect, we'd have gone from this low here, gone up to this high, and we would have stopped here at the 618 and gone higher. Now, some of you that follow me on TradingView saw that that was a trade that I was in, and that's exactly why I was in it. But if we look here, the only premise and only conclusion we can draw is that this market is bullish above 4130. We're bullish above. But we don't know how this resolves, because remember, this phenomenon, this retracement relationship is working both ways. Let's go down to a 4-hour. I can show it to you a little more clearly. So here we see it. Take note that the 200 period is providing support here. That's why it's worthwhile to have those. But if we look at this coming the other direction, right? We always have the other direction working at the same time and working against us if we're bulls here. Now, what's more bullish here is that we've gotten through the 618. We've gotten through the 618. Now, in Elliott trading, this could easily be an A and a B will often push up to a 786. It's a challenge for a new high that fails. So you end up, of course, with a lower high, and then we start to retrace deeper. But here, now, there are a lot of traders that will tell you this is the ideal spot to enter the market between the 618 and the 786. I would propose to you that you'll see it more commonly at the 50. That's what the algos like. That's where they will start to enter the market, and they will continue to maintain that directional bias right up to the 618. Now, again, nothing's perfect. It will go through it. There is sloppiness in the market, and there's front running. But the majority of the time, if you work within that foundation, acknowledging that the 786 does play a role, if you work from the premise that the 50 and the 618 are your key pivots and that's your sweet spot, more often than not, you're going to be well rewarded by that premise. So as we see this here, now we have a lack of resolution. So it becomes really difficult to know which way this is going and which way it's going to resolve, because we could easily move into an A again, or a retracement here. Here we're going to the 618. We don't break the 786. We could be heading down to these lower targets. Now take note that this lower target of the negative 23.6 lines up within a few dollars of the 786. So we could come all the way down to the 786 and maintain a bullish bias, because we would maintain a higher low here relative to this swing. But we don't really know. We don't really know which way it's going to go. Is it tradable here? Sure, because we're bullish above this 618. So if we go down to a smaller time frame, there's a trade here. Right? Now, this is what I mean by this happening on smaller and smaller time frames. It just repeats over and over again. So take a look at what happened here. So from this low, as we're coming down, we go to the 50. We don't quite get to the 618, or pardon me, to the negative 23.6. New low, front run to the 50. We get to the 23, bounce, then we go right to the negative 618. A few ticks below, and look how, of course, you've got your target here. And look, we just get a few dollars through it, but we hold the other 618, and then we rip higher. Right? Amazing. It's just again, over and over again, multiple time frames. So as we start to head higher, you see it again. So we go from this low to this high. We come to the tick, to the 50, up to the 23, back down to the 38. Again, we go. Rarely do you see it go through the negative 618 without some sort of a pullback. It happens, but rarely. We get through by a couple of ticks, and then we start the pullback. Then we start the retracement. This is all from Friday's action, right, where we know it was news driven. Again, there's no way to know that's coming. There's no way to know that's coming. All we care about is when it starts to move, how does it move? Right? So remember, again, this is happening from both sides, right? You got bulls and bears fighting it out here. So if we look from this high, we get in between the 50 and the 618, right back down. You think that's coincidence? I promise you it's not. It's not. Right? So you've got your target there where algos are going to take profit right within a few dollars of the 618 on the larger degree. Right? You see that? Then what do we do from there? Now from here, we go to that low. From the swing high, we're back up to the 50. Now we're coming down again. See, this becomes the resistance. 3 times, 3 hours. They try and get through. They can't get through. Can't get through. Starts to fall back down. So now we don't know. We don't know if we're heading down here to the negative 23.6 off of this retracement and target, or whether we're going to hold. Right? Because again, it's happening the other direction. So we go from here to here. Where are we stopped? Right at the 50. That's where we are as we speak. As I record this, we're threatening the 50 again. And you see that resistance. There's a group of traders and algos that are programmed to buy it right there, and they'll continue to buy it to the 618. And then some of them will flip, and then they'll be sellers. Right now, again, you've got algos here that want to push it down here because of this 50, and you got algos here that are trying to buy it for this. And there's no way for us to know which way that's going to resolve. All we can do is be cognizant of where we're likely to run into this support and resistance. Now, is there a trade here? Sure, there's a trade here. You could be. This is tradable right now. Now, here's where. Right? And here's where oscillators can offer some value. So if we bring in some of the oscillators to help us with timing, let's see can we get some benefit here. Well, so I've got an RSI, I've got the L8 wave oscillator, which if you're not aware, all that is a 5 and a 34 moving average shown as a histogram. But it's useful in showing divergences and where you have a third wave, which will always be the strongest or the highest point in the histogram. So we see we come down here, we get this doubling pattern here on the RSI. This is a multi-time RSI, and then down below I've got 2 standard deviations from the value-weighted average price, which is important to the algorithms. You don't need to get into the details there, but the volume weighted average price is an important metric for algorithms, and when you get 2 standard deviations from it, you'll often see the market start to work back towards the average price. So when I get 2 standard deviations above or below that, I want to be cognizant of it, because if it lines up with other things that I'm looking at, like a retracement, then I know there's increased probability that we're going to return to the mean, which is the volume weighted average price. So we're 2 standard deviations away from it here. We start working back towards it. It's not what you're looking at here. I don't have it up, but it's the same idea. All right, and then we get some divergence here. Boom, up we go. Now here, is this tradable? Yeah, absolutely. Right, because the trade, you could put this trade on here right at the 50. You've got, you can be tight with that. So you've got 3.5 to 1 on the first target, 5.3 to 1. If we're going up to challenge those highs, that's 7 to 1. Is that tradable? Absolutely. Could we get stopped out? Of course. We could get stopped out and the 786 holds it and then it rips higher. You don't know. But all I'm looking at is, do I have risk reward here that's favorable to me? Do I have risk reward that's favorable? First target is still 3.6 to 1. Absolutely tradable. Am I going to enter it here? I'd like to see this start to bottom. I want to see. Here's I've referenced it a couple of times, but this is the most important pattern that you want to pay attention to when you're looking, again, regardless of the time frame. It's this. Do we have movement followed by a retrace that leads to a higher low and then a higher high? That's the definition of a trend, whether it's up or down. So we have a swing here. We've had one retracement here that went up. Now we're coming back down. Can we set up here for a higher low? Do we get support here at the 50 of the 618? Now this has been going 50s to 618. The 618 is obviously meaningful in this market. So we're going to come down here to the 618. If we got a little bit lower on the RSI, got some divergence, it's absolutely tradable. Absolutely tradable. 3 to 1. Over 3 to 1. This is the pattern we want to look for entry. So there was a trade here there's a short-term trade from this low, buying as it turned just above the 618 and went up to this level. There's absolutely a trade there, but that's exactly where you'd want to be tightening your stop, right? Because you don't know, because you didn't get to your target. You didn't get to your negative 23. So we go back down. Are we going to re-challenge it? Looks like it. Looks like it. We're at the 50 now. I want to see swing, pivot, and I want to start to see some direction higher and make a trade based on the assumption that I've now got a solid higher low that would be consistent with movement and support at the 50. So here we sit at the 50. Is that tradable? Absolutely. Absolutely. You're risking from, what are we at, basically 42.95 to 42.20, $70. Very tradable. Very tradable. Be interesting to see when we look at this next where that goes. But that's the first target, right? But remember, we've got multiple targets here. So on the shorter term, on the 1 hour, first target is up here at 45.13, right? Which happens to be right in line with the 200 period. Second target up here at the 46.15, 100% back up here at these highs. But remember, we have resistance working against us both ways. So very tradable. If that starts to move a little bit higher, yeah, it could easily be a nice little trade. Nice little trade. Longer term target, let's go back to the 4 hour. Here's our major swing low. Here's the major target. 52.65. So this could be an entry that gets you in, that lets you position yourself to head towards that target. Right now, that is the highest probability of outcome. So this can be just a spot to get positioned for that to happen. If we start to move higher, there'll be other opportunities for that 50% retracement for you to add. Now you're adding with house money. That's how you compound your winners. When you're in the market, you've got profit, you've able to reduce the risk, and now you're adding with house money. That's what offsets all those times that you're going to get stopped out. And you will get stopped out more times than you won't. It's just the reality of trading. So you got to be prepared for it. You got to expect it, really. So the first question is always, where am I wrong? If I'm going into this trade, so there's two things you consider. What's the maximum amount of risk tolerance that I can afford given my account size and my risk parameters? And I would tell you to keep that at a maximum of 5% of your account on any one trade. What's the amount that you can withstand based on your risk tolerance and your money management rules? And where does the market prove you wrong? Right, so are you going to trade your wallet or are you going to trade the market? So here on a 4 hour, I mean, really the market doesn't prove you wrong until you break the 618, but that may be more risk than you want to take. Yeah, this let me pull this out. To truly let the market prove you wrong, you've got to be down here at 40.94. I want to see a meaningful break of that 618, not just a wick. For that to break, well, do you want to take that much risk? Now we're at $300 a contract, or depending on whether you're trading on leverage or depending on how you approach the market. But are you trading your wallet or are you trading the market? So if you go to a smaller time frame, now you take that same argument and you say, well, where does the market prove me wrong? Well, if I'm basing my entry off of this retracement, I could buy at the 50 and put a stop just below the 618. That's where the market proves that trade wrong. It could still come down to the 786 and hold. It could. But one of the things that you would look at here is, we know the market moves in 5s and 3s. So this action here, the fact that we get an ABC, we've got a 3-wave movement here, suggests that it's corrective, not impulsive. Not a good sign. Not a good sign on this time frame for this trade. Doesn't mean it won't hold, but this is where having some knowledge of how the market moves from an Elliott perspective, looking for impulse or corrective behavior, has benefit to us. So it's not what I would have rather liked to have seen is movement up here, so that at the very least I had 100% of this swing high. It could still be corrective, could still be an ABC, but what it does not appear to be is impulsive. So while we've got a line in the sand down here at 41.40, we've got behavior that's implying that it's corrective, not impulsive. So you could really make a reasonable argument the best place to be is out of the market if you're not in it. Does that make sense? All right, that should give you sort of an idea of these fundamentals. Now that you've seen it in Bitcoin, let's take it to another market. All right, so because I want to keep these videos, I'd like to keep them under an hour, no more than 45 minutes. Let's just do the two majors here on this first video, and of course we're going to look at other markets as well. But I'd rather break them up into individual videos so that you can watch them as your time allows, and we won't get buried in too many different markets at one time. So here's this is a daily. Now I've switched over to Bittrex here. So here's Ethereum to the US dollar tether on Bittrex, and with their data, we can only go back to May of 16 here. So this is an example of where daily data, while there's meaning here, it's not as meaningful to us. But I'd like to have more data to work with, so I'm going to go to a 12-hour. And okay, so just now I should make note here. I do have this indicator on here, which I do like to use, and you can get this right in your indicators. It's a combination of a Dolcian and a Bollinger Band. So I think if you just go here and you search under Bollinger, I think you'll find this thing is useful. And then you scroll down. Here it is, Dolcian Bollinger Hybrid. You just put a star on it, it'll be in your favorites. It's useful when you're drawing swings because it'll show you where the most recent swing highs and lows are. So looking here, I mean, we've got a market in a range, really, we've got a market in a range. We've got indecision. We've got this bullish move. We've got this very deep retracement. And then we've got another bullish move. And now we're sitting right about in the middle of it. But again, applying the same methodology, exact same methodology, on the premise that all I need is my fib retracement tool, we can start working from some of these lows and see what we get. Well, we're going to start here, work up to the high. What do we get? Well, we get the market hitting this 50, coming back up and stalling. It doesn't make the new high. It doesn't make the target. Right? Our target was way up here. We don't make it. Bad sign. Bad sign. So this is where we would want to be cognizant of the fact that we have the same relationships, the same fib relationships working the opposite direction. So if we now go from this high to this low, what do we see? Well, we get through the 618. This is an attempt to get up towards those high. It fails. And often you'll see this is there's a combination of stop running here. There's a push towards the new high. They can't get it. It stalls, and then it starts to fall. And where does it fall to? Right to the negative 23.6. I mean, almost to the dollar. It's just amazingly consistent, right? We're on a 12-hour chart of Ethereum. It's just consistent over and over again. So now we'd be looking at this. We'd pull down to this low. Right? We come back up. Profit taking. We know algos are taking profit there. They come up to the 50. There's the turn. Where do we come? Right back down to the negative 23.6. Again, it's remarkably consistent. Now, we'd go again, and we'd pull to that new low. The market starts to move higher. We get to the 618 here, and it doesn't break. Doesn't break. Now we're through the 786, so bullish from that perspective. But remember, since it's happening, since we've hit that target, and we might at this point be looking for a trend change because we've hit that target twice. So now, knowing that that's working the opposite direction, we'd go from this low to this high. Now we get through by a couple of ticks on the 618, but immediately rip higher. 23, we get through. Small retrace, doesn't need very, very moderate retrace. We get to the negative 618, pull back. Where do we end up? At the negative 100. Exactly 100% of this swing. Now along the way, right, we've got the move from this low to this high. Shallow. Shallow. Stronger the move, the more likely that there's. I consider it front running at the 382. At the 382. Now, so let's go down to a smaller time frame. Let's go down to the 8 hour and look at this. I'm going to pull this off for a minute. And again, you know, not to spend. You want to reference this, but again, I don't want to give you the impression that this is critical. But if anyone has any insight into Elliott wave, one of the most important things to an Elliott technician is if we think we've got an impulse structure, the wave 1 high becomes an important support or resistance level for us because it defines whether or not we have an impulsive structure. Now, we can still end up with a 5-wave structure through either leading or ending diagonals, but that's a subject for another video. But at this point in time, that's an important pivot for us. That's an important pivot. So if we look there, we can certainly make the case, and again, my premise is Elliott should be so incredibly obvious that a 6-year-old can see it. So as an Elliott trader, that's the wave structure that and if we're bulls, that we're playing on. Right? We've had a retracement here. The wave 1 held. We've moved up. So we've got, let's see if I've got this. So we're bullish above. We're bullish above. Now we can work from that wave 2 low to that wave 3 high. Again, that's where that Dulcian helps you with placement. I know you can hit the snap feature, but I find that somewhat annoying. So we hold the 618. So this is bullish, right? So we hold the 618 and we hold the wave 1 high. So where's our target? So our first target is right here at the negative 23.6. So we're bullish above. Bullish above. Long-term target, there's a negative 618 up at 530. Now, I would, since I can see that, I'm a big fan of median lines, and I'm going to show you this so that you see what I'm talking about. So if people often ask me, what's the deal with the trade devil? And it's really nothing devilish to it, other than I'm a big fan of working with median lines. I know that algos are programmed around them, and you'll find that they're amazingly consistent in terms of structure in the market. So in a situation like this, where we have the steepness of this first move, means that now we're outside of the bounds of that pitchfork. I would change it to a modified shift, which in effect just really all it does is change it to a channel. So if I go from here to a modified shift, right, we see that we go right up to the tip of the channel, right, and then we get a little bit through it here. But we snap back into it, right. They're really powerful, really powerful. But you could, just for simplicity and not to confuse you, we could just go to a parallel channel and work from this low to this low to this high. We get that same sort of structured target up here. But I would also do this, since we've gone outside of it. We could do it with a trend line. I want to be cognizant of this, what's called a warning line or a perimeter line here, because we've gone outside of it. So if a break of that would be decisively bearish. So we look here, and right, we want to apply the same methodology here. So we're going to go back to our fib retracement. We're going to go from this low to this high. I'm going to pull this off for the time being, just so we don't clutter the chart. So if we're trading down here on this time frame, let's go down. Let's go to a 4-hour and look at this. Okay, well, we got, this is bearish, right? So we're through the 786, but look how quickly we snap back. It's something that you see a lot in crypto, and it would be similar if you were looking at a 2-minute chart in the Forex market. You see a lot of wicks, a lot of long wicks, and a lot of times that's stop running. That's market orders getting filled and somebody getting screwed on a fill. But it's something I'm much more interested in where the body is than the wicks. I want to pay attention to the wicks because that is the highest high of that movement. But I really want to be aware of where the body is and be cognizant of what I think is likely happening here, which is just this is a stop run, as we quickly go back into that consolidation. Now, I mean, here because we're above this wave one high, we're still bullish. My bias is bullish because I'm looking at this wave count saying there's an opportunity for this to complete as long as we stay above this wave one high. So is there a trade here? Sure. But again, remember, this is always working against you on the opposite side. So you have to draw these and know where they are. So from this wave, from this high here to this low, look what we get. Well, we're through the 618. We don't make the 786. We come down, boom, right to the negative 618. I promise you that's not coincidence, right? Not coincidence. And it happens to be just a few dollars above the wave one high, which happens to be, we go from this low, right where that 618 is. That is not coincidence. You got to know that's there, right? You got to know it's there. If there's a pivot in the market, it's almost always going to be tied to some fib relationship. And if you can't find it, you got to keep looking. Or it's a pivot that's going to be broken. So we come down to the 618, I mean almost to the dollar, knowing that. So now we go from here and we go to that low, and now we've got this happening. Well, we've also, take note, from that pivot, got this one here. Now we're through the 618 here. This leans me to the bullish side, but we get this news event and we drop down. So I'd work from this swing high, absolute high. And we don't know here. We don't know whether we're going down to this target here of the negative 23.6 to the negative 6.1. We don't know what we're doing. But I know that I'm bullish above this low here, that wave one, that 618. We hit that target. That was a negative 618. That's a solid low from which to base a trade. So is this tradable? Absolutely. Absolutely. We also have a low here, retrace, and then we have a higher low. So now we're on a 4 hour. So if we come down to a 1 hour, again, it's happening on a time frame. We don't know how this resolves. What I see here is just, it's Saturday, the afternoon. There's not a lot of volume. It's just congestion. It's not impulsive. I'll tell you that. It's not impulsive. If anything, it's impulsive to the downside. So we could, you've got to continue to draw these up on multiple time frames. We don't know. Right now, we're bullish above this line, and we've had a deep retracement. So there is a possibility that we've got this happening here. For, again, in Elliott terms, this is where some Elliott wave is helpful, that we've got this wave structure happening within the fifth wave, right? So we've got a 3, we've got a 4, and now we're going to go up in some sort of impulsive 5-wave sequence. We don't know. But right now, that's a good low. Is this tradable? Yeah. I would want to see, again, I'd rather see some impulsive behavior. All I see is chop right now. But it's absolutely tradable. We could put it. We could enter if we enter the market right here. Do you want to take that trade? You've got 3 to 1. It's not bad. It's absolutely tradable. Nothing wrong with it. You want to let the market dictate it? Now you got to go down here, and so you got to get more out of it. You got to get more out of it to at least get there's 2.5 to 1. We go back up and retest the high. I wouldn't take that much risk. If I was going into it right now, I'd use that pivot as a low. Now, let's be reasonable with our targets. There's 3.5 to 1. Is it tradable? Yeah. That it's $300. Ethereum's at we're at $295. We're risking down to $275. This is $20. Is that tradable? Yeah. Absolutely. Keep in mind, though, again, as I keep reminding you, that the one thing we know is that we have not been able to get through this. Let's take this off. So again, we've got this pattern happening over and over again. Let me take some of this off just to show you this. So I can go from this high to this low, and take note, we go right to the 618. Right to the 618, to the tick. And now we come back down. We hit the 50 here on this side. I mean, this is just a range-bound market. There's no decisiveness. It's waiting. It's waiting for somebody to win the battle. Bulls or bears. We're either going down here and we retest. Right? So if we look here at this 618, the swing high to the 618, we come back down. Our target here is that negative 23.6. We saw that happen over here on this swing low. So this is another very reasonable spot to look for support. But if we're trading it long here, do we want to give it that much room? You know, that's up to you as an individual trader. I'm bullish above that line. So if we hold here and start to move higher, that's absolutely tradable, because what I'm looking for is at the very least 100% of this. So we could go to the alternate, take that swing high from this swing low, and there's 100% of it. So if I'm trading that now at this entry, I want to at least see 100% of it with that low. That's just about 3 to 1. Could go higher. Certainly could go higher. There's the 1.618, right? If I get an impulse off of this, or if I get an impulsive move off of this, yeah, if that's the 1, that's the 2, there's the 3, that's the likely target for a third wave. 1.618 of it. Now we're back at 402, and I've got a 5 to 1 trade. Yeah, very tradable, very tradable. All right, we're at 50 minutes, so let me break it there on this video, and I'm going to do a couple of more on some other major coins. But I wanted to demonstrate the basics here and let you guys start playing with that for whatever cryptocurrency you're interested in, you're looking at, you're trading, however you find yourself looking at any one individual coin. I want to give you this basic methodology, and what you're going to find is you're going to see this repeated over and over and over again. And as you get comfortable with it, my goal is for you to reach the point where you don't need me. You know, you're able to apply this. It's not that complicated. Where it gets complicated is how you respond to it and dealing with the emotional side of trading, which is having money at risk and dealing with your ego and being willing to accept that you're going to be wrong more than you're right. It's easier said than done. But the actual mechanics of how you analyze a market is relatively simple, right? So that should give you a little something to chew on and work with over the weekend. I'll be posting some more videos with the same methodology. I'll do another 2 coins later today so you can see it applied, and then start working with it yourselves. All right, guys, have a good weekend. See you later.